Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. We get a lot of love from our viewers, especially on the new age companies which are getting listed, to get them ASAP on KYC as well. So of course, we are continuing that trend as well. There is a hint to it, but I'll give you the company's name a bit later. Let's just see what are the hints which the company is going to come today at KYC. The company is offering software solutions for loyalty programs. So there is a niche play here, maybe a SaaS product or a solution company. That stock is down 11% from the IPO price as well. And in this pre-IPO rounds, or the anchor investors backed by ValueQuest and Amundi as well. So big, large investors are definitely there in this. But I'll give you a little bit more hint about it. The company's name, the initial name is very interesting. I googled a little bit because I'm a bit weak in biology. Capillary, that's the name I'm talking about. This is just a small tube which transports blood. Interesting name and interesting company to talk about. But it's just not the name we get a company in KYC. There are a lot of questions which arises from my analysis and also from a lot of feedback from you all. So let's see what are the questions which we need to ask. The 5-year strategic deal they have secured recently from a US client. It's a big deal, $20 million. What are the key details about it? What are the contours about it? The $20 million acquisition they have started, and that is for the MasterCard arm. Remember, the company is focusing on a lot in the merger acquisition strategy also. That's an interesting model, but will the Indian markets accept this kind of model and give the valuations? That's what something time will suggest. Any threat coming in from the larger AI players, because the day anything comes from Claude or Anthropic, most of the SaaS players start getting derated. Is that company actually AI proof? That's the question. Inquiries and demand trends for 2026, how things are looking up, and the geographical revenue breakup also. We'll ask the management how things are moving and what is leading to that. Also, another question to be asked is the overall net revenue retention and the margin guidance going ahead. It's a bit technical, but I'll give you all the definitions so that your analysis is very simple, and that's my job to get that for you. The status on the migrations of this acquisition accounts, it's very simple. जो merger acquisition company का किया है उसको core business में लाना है. How do they do that and by when do they do that? At least the return should be maintained for the investors. And to give us all these details about the company and solve all our queries, we'll be joined by Aneesh Reddy. He's the founder and CEO at Capillary Tech on the show. But let's give it more details about the company. थोड़ा सा technical लग रहा होगा, but I will simplify it for you. अब let's see what's that company all about. First thing is it was founded in 2012. It's a software product company. Of course, you can add AI, SaaS. This is what my technical folks would understand. But to put in perspective, it just provides enterprise customers for loyalty programs. This can be end-to-end. So it's a pretty much niche area, but nevertheless it's growing because corporates are growing, quantification is growing, and this is an important growing segment as well. Let's talk about the other details also. क्या company करता है? Advanced loyalty management, connected engagement, predictive analytics. So basically it becomes a flywheel. One service is there, another service is connected to it, and eventually monetization also happens. And this is how you build a tech product stack, and that's where I think there is a moat in this company. Customers, 115 of them, good Fortune 500, 20 of them are there, and roughly 47 countries the company is present in. So it is growing, it's growing in a niche segment. Let's see if we can actually defend its valuations, because there's a merger acquisition play always there. Just look at the bigger names. Indian names also includes Aditya Birla Group. Internationally, there's Domino, Puma, Abott. All these are the major clients for Capillary Tech, but definitely they have a major share coming from the abroad. 89% revenue comes from subscription. So this is very much important, and most of the legacy contracts also the company is focusing on is to make it in the subscription model. That is where the definition starts coming in, those numbers like ARR, MRR. I'll explain you that. There's nothing big concern about it. But recently there's a big US order win. That's also one of the reasons we are getting this company to understand about this important order win. This is roughly $20 billion, but देखिए 5 साल का है. So divided into $4 million. So that is what I want to explain you. Whenever a company announces such a big order, take it with a pinch of salt. There's an acquisition also at play, a US company acquisition. They have acquired MasterCard's arm Session M. So we'll understand how much this acquisition is going to start putting in the benefit. It's also $20 million, but something which I really liked about this acquisition is at the price which has been done. Valuation kya tha acquisition ka, and of course this is the company I'm talking about, but the price to sales ratio is just 0.4 times of this acquisition. That is actually lower than what actually they have given. Almost 0.5 to 1.5 is the target. So this is a very cheap acquisition for them. That means it is going right when it comes to their business strategy of mergers and acquisitions. But when you understand this segment, you should understand ki ye definition kya hai. So I'll simplify it more for you. NRR means net revenue retention. That is important when you track this company. M&A, merger, acquisition, every 5 minutes you are going to be hearing a lot about this because the company's business model is as such. And ARR, this is nothing but the annual recurring revenue. This is what we'll be talking about. So एक revision आप कर लीजिए. This is important. Now let's move on to the story about the company. And the net revenue retention, organic business, which is their core business, it's 115%. They keep on acquiring, that is 96%. I checked with a technical analyst and they told 120% should be an ideal target if the company is growing at a strong level. So company is at par or slightly below par with that net revenue for a SaaS loyalty player. But there are a lot of questions to be asked. Of course, the second question is there any threat coming from AI for this model? And if yes, is the company making any guardrail for it? And will this business model of merger acquisition put the strain on the financials? Because if the company is continuously at play with mergers and acquisitions, you will see pressure on the return ratios, at times even balance sheet as well. But enough of questions, let's start finding the answers. So the answers first we need to find is from the rating parameters which we judge a company in KYC. This is the basic income, balance sheet, cash flow, holy grail of numbers to talk about. Return ratios, very much important. But remember, the business model is a bit different, so there might be a bit pressure. And that is why, to balance things out, I have actually interestingly removed the valuations and the peer analysis. The peer analysis is not there. Operational parameters would be fair to judge a company at this stage of the business cycle. Shareholding street cred, yaad rakhiye, it is a very small. It's recently listed in November, so आपको सिर्फ एक quarter का ही data मिलेगा. And outlook, is it very much important for both organic and inorganic business? We'll get you all those details in a simplified manner. But let's talk about the first rating parameter, and that's the income statement. And that is where a little bit of my concern comes. See, the top line is going good. It's almost doubled from FY23 and it's around 600 odd crores in FY25. We're going to check the Q3 numbers also, but the bottom line numbers, because the company is in a growth model, but the situation which has come in, the perception of a SaaS company, what has come in, if the profits don't come, the markets may not reward you as yet. And the Q3 numbers also, let's look at it, how things have moved. It has been largely a flattish move. I've taken these numbers on a year-on-year basis. The market also needs to understand. In terms of profitability, little bit up move definitely has come. It's around 8 odd crore rupees. The adjusted margin is something which the company claims that it's doing really well. That'll be very interesting to understand how to study this segment. This is the calculated margins, by the way. So top line, there might be a good growth if you look at the long-term basis. Short-term Q3 numbers, nothing much greater, but of course the PAT number, that is something which has done well. But will it continue or not? That's the question. And that is why I've given a neutral rating. Let's talk about balance sheet, how things are actually moving in this space. And balance sheet also, largely remember, company has come out with its IPO and the equity base has kind of increased going ahead. The debt numbers, if I talk about it, the borrowing, that has actually slightly gone up as well, and it will be very not a challenge, but I would say a tough ask, the way company is doing mergers and acquisitions. That is where we can see that the company will be actually looking out for. Almost 214 crore cash balance also, that's decent for these inorganic acquisitions, but the balance sheet management will be the clear test. So it's a neutral rating when it comes to the balance sheet. But because of the lumpiness which comes in, and there's also merger and acquisition at play, so it's just not the operating cash flows to look at, because that is actually on the lower side as well. But the net P&L, that's on the higher side, and the net flows are still positive. But jitna financing, investing chalega, it will definitely impact your operating cash flows. So the net cash flows will always be very volatile for a business model which Capillary Tech is actually going through. So it's a neutral rating over here also. So all of the three bigger numbers which I talk about it, there is some good point, there is some overhang, and that's why we are stuck at neutral rating. Also, let's point out the fourth category to talk about, and this is definitely going to be this return ratios, but this is the equity base. There's a significant increase in that. That's what the company has stated. From company side, it is a stable move, but single digit ROE numbers or the ROCE numbers which you talk about, which the company itself has stated, it is still looking dismal. It takes time for this kind of a model to actually give you the actual ROE or ROCE number, or maybe there is another criteria where we can judge the company on these return ratios. It takes time for the Indian markets to understand it, and even at the business cycle which company is there. So as of now, it's a thumbs down when it comes to the return ratios. Let's also talk about the shareholding. In shareholding, promoters have a decent stake of 52%, and I must say that good DIs and FIs have been there over here, and 26% from public. The history is small, so let's be fair. Let's give it a neutral rating and move on fast to the street cred. Remember the IPO numbers. The company came out in the month of November. That means देखा जाए तो सिर्फ 2.5 से 3 महीना ही हुआ है. उसमें from the IPO price, the stock is down 11%. From the listing price also, stock is down 10%. Remember, this time there was a lot of volatility in the global markets, small cap indices, everyone did actually weak as well. But nevertheless, on the street cred, as of now, if you are in the IPO, it's largely, you could say, the price is down 10% odd. After the IPO also, money hasn't been made yet. So for that basis, I have given a thumbs down when it comes to the street cred. But I have given one more important change in the rating parameter. I haven't taken valuations, I haven't taken peer analysis. To be fair, these companies need to be seen in their operational parameters also. आपको मैंने definition पहले बता दिया था net revenue retention के बारे में. FY24, FY25, so these are the numbers I talk about, and 121% is definitely a decent growth coming in for this net revenue retention. This simply means like your customer is there and they are retained, and that revenue keeps on coming in. So it becomes not a perpetuity but a long-term kind of a revenue recognition numbers which this startup or now a listed company is following. So as of now, operational parameters is strong. It's a thumbs up when it comes to the operational parameters. But let's also look at the outlook, how things are panning out. 20% organic annual growth rate they're talking about. This is likely the top line growth. 2 times non-cost of goods sold cost. That is something which the company has mentioned, but at times the clarity doesn't come, even for me. So we'll definitely ask the company what this guidance is actually all about. The platform usage and the inflationary increases, that's also coming in. At times it becomes a cause of concern, and the product upgrades, service upsell, and the new brands, that is what the company is focusing on going ahead in the future. A stronger merger acquisition strategy, that's what we have seen. They are buying things cheap, something which is ancillary to the business model. But the question remains is customers कब migrate होंगे नए acquired business से core business में. That's the entire philosophy, to put it in a very simple manner for you. 75% of this revenue retention for this inorganic business I'm talking about, and 45% free cash flow would be coming in. Both will be, of course, integrated, and then we'll move ahead with it. But a lot of calculation, a lot of maths is there, and I'm trying to simplify it for you, and we'll ask the management the entire setup. So right now, it's a neutral rating when it comes to the overall outlook. But let's add up the entire ratings and see where does the company stand and what the company needs to do more for the stakeholders. Income statement, balance sheet, cash flow, there is something positive, but there's an overhang. We ensured that for you. Return ratios at this business stage model, don't expect that. Shareholding, street cred, I would just say it's just been 2 months of total data. So let's be fair in our analysis on that. Operational parameters is good. That's where the growth is coming in. But outlook, there is of course growth coming for both organic and inorganic. But as the technology changes, does it impact the SaaS segment a bit, on the negative side? So that's a question mark. So we have kept it 3.5 out of 8 totally for Capillary Tech. And definitely we'll ask more questions about the company from Aneesh Reddy. He's the founder and CEO at Capillary Tech. But I want to give you some important flavor about him. He has almost 2 decades of experience in tech, and not only that, he's an angel investor and mentor to a lot of SaaS startups. Maybe from his mentorship, we can get more listed companies in this space as well, and education from IIT Kharagpur. So joining us is Aneesh Reddy, the founder and CEO at Capillary Tech. Good afternoon, Aneesh. Always a pleasure to have you here in our show. But Aneesh, just like to talk about the deals and the mergers, acquisitions, more than the company from the IPO. A lot of news flows are coming regarding the deal wins, regarding acquisitions. I want to start with that, especially with this 5-year deal win which has come in. And if you could just give us, when can the incremental benefits starts coming in and how are the inquiries looking like?
Sharad, thanks for having me on the call. Really appreciate it. I think it's just been 3 months since we listed, so really grateful to all the shareholders for having the confidence in us, right? So I think the business has been doing phenomenally well, which is why the news and all that stuff. We're usually a media shy thing, but I think once you list, you have to put all of this out regulatorily, right? So whether it's the acquisitions, whether it's the large deal wins. So this one is, the one on the screen now is a very large Fortune 50 retailer in the US. It's a $20 million deal over 5 years. Actually, it's a longer term deal. You can keep adding. There's another chance for them to extend another 4 years if they want to, right? So it could be more than 5 years as well. And it is really one of the top 5 retailers in the US, right? So very, very good firm there. They really liked our loyalty and our AI stack. Now, this is an organic customer. Usually our customers take about 5-6 months to go live, but they start paying us from the day they sign, right? So you will start seeing this entire revenue, the 4-5 million increase per annual increase, right? You would see that play in over the next, I'd say 6 to 9 months. You will see the entire thing play out. So at least compared to where we are, I'd say at least a 5-6% of the of growth just from this single contract, you will see it play out, right? By probably 6 months from now, right? So yeah.
All right. So that's a very interesting take from Aneesh. It can be an extension, 5 saal plus 4 saal, 9 saal. Interesting, and of course a good contribution in the revenue as well. But apart from the deal acquisitions, that is something which I might say is one of the core principles of your expansion plan as well. And there is a acquisition of $20 million coming in for MasterCard's arm. It's a Session M. But the thing which I'd like to congratulate Aneesh you is on the deal valuation. It's happening at 0.4 times, and you have given a rating that the deal should be between 0.5 to 1.5 times. So can we get all these suppressed deals in this acquisition pipeline for 2026? Anything else looking good here?
Yeah, so let me talk about first our acquisition strategy a bit, Sharad. So we buy only loyalty companies. We only buy our competitors, right? So, and the reason for that is, that the risk on product is much lower, right? And if you look at the Capillary product, we are rated the best globally by any analyst. So if you pick a Forrester or Forrester is a large analyst in the West, US, Europe, etc. And they publish a report every 18 months on the loyalty space, which are the best companies. And for the last couple of years, we are rated right at the top, right? So we are the best company rated there. Now for a MasterCard, they had this product. They have a lot of good customers, who also work with them on the payment side, right? So for them, it was more about finding the best home for those customers, that product, right? So it was not as much, Capillary se kitna paisa banayenge, right? How much money will they make from Capillary? So their analysis was more saying, we have to do the right thing for our customers and find the best company that we can give this to, right? So which is why and MasterCard is a great company, right? It is in the top 25 most valuable companies globally. They've always done the right thing for their customers. So this is the pricing is something you should not really take that seriously, for that reason that that they wanted to find the best home, and we are known to be the best product in the space, right? So we work with 25 of the Fortune 500 now. We've 2 of the Fortune 10, right? So Like we do only one thing, we do only loyalty, but we are the best in the world at that, right? So, and that's why that acquisition price and why a large brand like MasterCard would like sell it to us. Look at it, it's an interesting time.
Right.
Will we do more
Right.
acquisitions? I don't know,
Right.
but we are, you can assume that the deal values will be in that half times to 1 times type.
Yes, Aneesh, that we have seen, and maybe you have a bargaining power. That's why you get things cheap as well. But Aneesh, a question is, of course, you're a mentor also to a lot of folks in the SaaS industries. But this question always comes, and a lot of viewers who track the IT space or the product space ask me, the AI impact, if any impact or a plugin comes in from Claude or an Anthropic, does it impact a SaaS player like you? Because you yourself are an advocate of AI. I've heard you in a lot of events also. But Aneesh, just wanted to understand regarding AI, and is it a friend or a foe for your company? And if yes, how are you implementing it, or any impact we can see? What is that entire, air about?
Right. Yeah, so if you look at this large retailer who's bought from us, they've bought loyalty and they've bought our AI stack, right? Now that's also in the press release if you see that. So AI for us is for all, not all software companies will benefit from AI or will lose from AI, right? So we are a system of record, right? All the customer data sits with us. The ledger on how many points, milestones, rewards, your tier, all of that in your loyalty piece also sits with us, right? So we are a little bit of a system of record for both the customer data and for all the your points and all of that, right? So for usually for a system of record, I think AI is a net benefit, because what will happen is system of records can become more smarter system of records using AI and displace like systems of workflow and systems of intelligence. जैसे कि like पहले क्या होता था कि you would have these analytics agencies who would take data out from us. We would pipe data out to them for these large enterprises, and they would run these analytics for them, charge them separately, right? Now AI can do that analyst wala work, right? It can actually sit down, and especially you can have a small language model or you can have a bunch of RAGs where you're training the AI to say, किसी ने अगर ये problem बताया आपको,
Right.
so this is how you solve it, right?
Anish,
so for us,
exactly. So
that has net benefit.
Yes, Anish, but just to put in terms of, a simple analysis or just an outlook going ahead, because you have given organic, inorganic, it's a bit technical for even me to make my audience understand. Just to put it in simplified manner, overall consolidated revenue growth and the margin growth, if you could give us any numbers next 2 to 3 years, what will happen? Because I know a lot of merger acquisition is happening, so it's not fair for me to judge the company on return ratios or bottom line numbers. But अगर adjusted EBITDA margin क्या हो सकता है 2-3 साल में, maybe you can give a feel.
Right. So let me break that a little bit for you, right? So if you look at us, last 3 years, we've had a 50% plus CAGR of growth, right? Last 3 years. Now, about half of that has come from organic, half has come from acquisitions, right? So basically what we're saying is even looking forward from this from the 598 crores that you see there, we will continue to grow 20% plus even if we don't do acquisitions, right? So, and of course, this is a big acquisition. It adds 35 million of revenues to the company. So, वो सब आपकी growth में ज़्यादा आएगा, right? So you will end up growing a little bit more than 20%, शायद 30 or शायद 40 हो, basis whatever the inorganic number you're seeing, right? So now again, if you look at EBITDA and the number to look at for Capillary is actually कितना cash हम लोग generate कर, right? So the business generates a lot of cash. अगर आप देखोगे तो the first 9 months we generated 100 crores of cash, like hard cash, right? On revenues of I think 560 something crores, right? 500 and like around that, right? So it is when it comes to net profit, there is depreciation for acquisitions you've done in the past, right? There's amortization for them. There is a lot of that, right? So which is actually non-cash expenses. So a good way to look at it actually is more a cash ROIC.
Yes. So
net
cash,
profit
yes.
is
So Anish, the thing is cash ROIC is something which all our viewers, if you're understanding, please track that for the company. And also without acquisition, it's a 20% plus growth coming in. But Anish, last question to you. This migration, the acquisition account, कोई धंधा आप खरीदते हैं, फिर वो धंधा जो है, it moves to your core business. How much time generally does it take for this? And right now you just did an acquisition. So if you could just give us some flavor of that.
Yeah, Sharan, so we've done 5 acquisitions over the last 4 years. So roughly, I would say a third of our revenue, we're today at a 750 crore run rate, right? If you take the 184 into 4 roughly, right? So a third of our revenue has come from acquisitions in the past. So 3 of those acquisitions are fully migrated, right? Where customers have moved over, we make like a 45% free cash margin on each of those customers who have moved over. So it's usually I would say like a 12 to a 24-month cycle. Not everyone migrates at the same
Okay,
time.
Anish. So that's a very important data you mentioned, 12 to 24 months. That's a very interesting take on it. Thanks a lot, Anish, for taking out your time. We are out of time right now, but you have given a very interesting picture and cleared a lot of air regarding your company and its strategy going ahead. It's always a pleasure to talk with you, Anish, and we'll get back to you for more. So that's the management of Capillary Tech talking about their growth strategies and also clearing a lot of air, which there was a bit of confusion post the IPO as well. And that's what we do in KYC. Stay tuned to NDTV Profit for more action.